Hello, this is John Norquay of Pivot Point Advisors. I had a question this weekend as to how we manage our portfolios and why we do some of the things that we do, such as why do we buy when a market is going down sometimes, and why do we sell when it's going up? So I figured the best way to respond to that was to actually show you a video as to how and what we've actually done with our moderate aggressive portfolio. You know, our attempt is to buy low and to sell high. We know that we're not going to be perfect all the time. So how do we actually manage the risk? We want to buy when the price is at a wholesale level, and we want to sell when the price is at a retail level. So since we know that we're not going to be right all the time, when we feel the market is low or at a wholesale price, we'll actually only put a few toes in. We consider a toe to be 10% of our portfolio. So we might put 3 toes in, which would be 30%. If the market pulls back even further, you know, at a further discount, we like discounts, right? Then we'll even put a couple more toes in. The best way to show you is to actually show you. So we're going back to February 21st. This is the S&P 500 chart. You can see that we've had a very nice increase in the market over the last couple of months. But at this point, we feel that the market is hitting a high, so we are banking our returns and going flat, which means we have nothing invested in the market anymore. So let's see what happens from this point. After we sell, the market goes down a little bit. Actually continues to make a couple more new highs, but then pulls back to where we feel is a wholesale or a support area. So we buy 30%. We put 3 toes in. We have a total of 30% invested now, and the market very quickly jumps right back up. Doesn't give us an opportunity to put any more toes into the water. And over the course of the next week or two, goes up substantially. We feel that this is plenty, and we actually sell the 30%, put it in the bank, and now we have a flat account again. We have nothing invested. Next day pulls back. We feel that we can make another short-term profit, so we put 3 toes in. Market goes down even further. We have a bigger discount, so we put 2 more toes in for, now we have a whole foot in, 50%. And very next day, we get a nice pop, so we book it right away, put it into the bank. Now, over the next few days, market kind of goes sideways and starts to pull back again. So we put 3 more toes in. Pulls back even further, so we put 2 more toes in. Now we have a total of 50% invested. Now as the market starts to go up a little more, we put even more toes in, so you have 70% invested, now 85% invested. But you can see what's happening. Even though the lows are getting higher, we're kind of in a congestion zone. We expect, based off of how things have been setting up, that we are going to break out of the top side of this congestion zone because we're pretty much fully invested. However, you'll be able to see the next day we actually break out on the bottom side, which is very bad news. We're not very happy about it. So we determine we have more risk out there now than what we're comfortable with. We determine that if the market starts to go up, we are going to start taking some of these positions back out so we can have some more safety in the portfolio. So next day it starts to pop up, so we take a couple toes out. Now we only have 60% invested. It continues to go up. Market looks like it's peaking. So we take a profit on another 35% of our portfolio. So now we only have 2.5 toes left in the market. And you can see that as the market pulls back, we now go flat. And with the whole sequence, again, the sequence is from the time that we're taking new positions to the time that we get rid of those positions is one full sequence. The sequence has left us a little bit of a profit, but we're happy to be out of the market at this point. So as the market continues, it actually goes down further and further and further. Now we actually went off the bottom of my screen, so I better take the screen down a little ways. And market continues to go down further and further. Now we're down to where we feel is a new wholesale level where there's some support. So we put 3 toes back in the water. But we're wrong. It's not the bottom. And the next day, the lows show us that our sequence is probably not going to be successful because our premise is now broken with how far it went down the next day. So when it goes back up, we want to try getting our money back out and be safe. Thank goodness we do have the increase. We sell that 30% position for a small profit, and that brings us up until today. So we're not feeling so good about the market right now. We know that it needs to do some things in order to prove that this last low was truly a low and doesn't have further down to go. So thank you for listening, and we will see you at the next briefing.